Well, David Kaplan from Barclays Capital joins us live now from the Tel Aviv Stock Exchange. David, good to have you on the program. And I know that you're saying that the Leviathan oil fields will see some pretty big potential from all of this.
Well, again, I think the important thing to mention here is that the Leviathan oil fields are low probability, low oil fields, but we are talking about gross mean potential of 3.7 billion barrels of oil. And I think that when you take into account the fact that Israel has never been energy independent before, that's why this becomes very important. And again, higher oil prices won't hurt exploration, but even in a lower price environment, I think that the Israeli exploration goes ahead as planned.
So let's talk through some of the other companies involved. I know they're watching Delek Drilling very closely, seen some big gains after signing a gas deal. Does it have further upside?
I think so. I think this is the first two agreements were signed just this week, and there's going to be some more to come. Delek Drilling has working interests both in the Tamar field, which is 9 trillion cubic feet of gas, and is expected to start delivering gas to Israel in early 2013. But it also has working interest in the Leviathan field, which is the one we talked about earlier, which is 17 trillion cubic feet of gas, as well as the potential for the oil that we talked about. And that's what makes Delek Drilling so interesting to investors right now.
And with other companies, you say that ratio oil has more risk, but then offers high potential reward as well. If we just take a look at the share price so far, it has actually underperformed some of the other Israeli companies. So why is that?
Well, to some extent, I think that the main reason, of course, is that ratio is a pure play on Leviathan at this stage of the game. It has a 15% working interest, and therein lies the higher risk-reward scenario for ratio relative to some of its peers. I think that perhaps some of the underperformance has to do with that fact and with all of the eggs, so to speak, in one basket of Leviathan as opposed to a wider spread portfolio. But I think if we look over the course of over the near term in the first quarter, as the Leviathan 1 deep targets are going to be drilled for these oil targets, I think that's where we potentially could see some better share performance from ratio as opposed to its peers, again, assuming that the drilling goes well as planned.
David Kaplan, thank you very much, analyst at Barclays Capital in Tel Aviv.